As a financial analyst, I've conducted a comprehensive comparative analysis of GE Aerospace, GE, against its key competitors in the aerospace and defense sector. This analysis is based on recent annual, TTM, and quarterly financial data from reputable sources like Yahoo Finance, Stock Analysis, and Bloomberg. 1. Data sourcing. The analysis includes GE Aerospace and the following key competitors: Raytheon Technologies, RTX, Rolls-Royce Holdings, RICE, Safran SA, SAF.PA, Honeywell International, Raytheon, Boeing, BA, Northrop Grumman, NOC, Lockheed Martin, LMT, General Dynamics, GD, MTU Aero Engines, MTX, F. It's important to note that Pratt & Whitney is a division of RTX and is therefore included in RTX's consolidated financials. 2. Ratio analysis and comparison. The following table presents a snapshot of 15 key financial ratios for GE Aerospace and its competitors, providing a foundation for our comparative assessment. Due to varying reporting periods and market volatility, some ratios, particularly for loss-making companies like Boeing and Safran, may be negative or unavailable. NA. 3. Industry context. The aerospace and defense industry is diverse, encompassing commercial aviation, defense contracts, and industrial technology. As a result, typical ratio benchmarks vary. However, general trends exist. Valuation, PE, and EV/EBITDA ratios are typically higher than the broader market, reflecting investor confidence in long-term contracts and duopolistic market structures. Forward PE is particularly important for this sector, as it captures long-term growth expectations. Profitability. Gross and operating margins are strong for component and engine manufacturers like GE, RTX, Safran, but can be volatile for prime contractors like Boeing, which have recently faced production issues. ROE and ROA are also generally healthy, but are often influenced by debt levels. Financial health. The sector often carries significant debt due to high capital expenditures, R&D, and long-term production cycles. A DE ratio under 1.0 or 100% is generally considered strong, but higher ratios are not uncommon. Growth. Revenue and EPS growth can fluctuate based on defense spending, commercial aircraft cycles, and supply chain health. 4. Overall assessment. Based on the comparative analysis, here is an overall assessment of GE Aerospace relative to its peer group. Valuation. GE Aerospace stands out with the highest trailing PE ratio at 41.3x and a relatively high forward PE of 26.5x. This suggests that investors are pricing in significant future growth and profitability improvements post-spin-off, paying a premium relative to peers like Lockheed Martin, 26.7x, and Northrop Grumman, 21.3x, which have lower, more typical PE ratios, while its high PB 7.32x and PS 7.5x ratios also indicate a premium valuation. They are supported by its robust profitability metrics. Financial strength. GE Aerospace exhibits strong financial health with a low debt-to-equity ratio of 5.5%. This is a notable strength compared to most competitors, particularly Boeing, 106.6%, and Safran, 85.2%, which carry much higher debt burdens. This low leverage provides GE with greater financial flexibility and resilience. Its high free cash flow of $7.75 billion is also a key competitive advantage, demonstrating its ability to generate substantial cash from operations, a crucial metric for high capex industries. This FCF figure is among the highest in the group, second only to some defense contractors. Profitability and efficiency. GE Aerospace is a profitability leader within the peer group. It boasts the highest return on equity, ROE, at 39.2%, indicating superior efficiency in generating profits from shareholder capital. While Rolls-Royce's ROE is exceptionally high, this is likely a result of recent financial restructuring and a low equity base rather than consistent operational performance. Growth and efficiency. GE Aerospace shows outstanding growth momentum, evidenced by its impressive year-over-year EPS growth of 176.6% and revenue growth of 21.2%. This performance, driven by a rebound in commercial aviation and strong demand for new aircraft engines, is significantly higher than most peers, with the exception of Rolls-Royce's revenue growth. This rapid expansion is a major driver of its premium valuation and indicates a strong growth trajectory post-separation from GE. In conclusion, GE Aerospace is a high-growth, high-profitability company that is currently valued at a premium by the market. Its exceptional financial strength, low leverage, and powerful cash flow generation position it as a leader in the sector. While its valuation ratios are higher than many peers, they are largely justified by its superior profitability and explosive growth prospects, making it an attractive long-term investment in the aerospace industry.